Hello and welcome to the final part in our series on federal student loans. We've talked about a number of things. We've talked about income-driven payment plans, how those payment plans affect your ability to buy a house. We've covered student loans for married couples, and today we are actually ending up with private loans. What's the difference between those and federal loans and why you might consider it in your situation? Let's get started. Now, even though today's video is about private loans, we do have to talk about why you would consider those versus a federal loan first. So, if you've been following the videos on things like the income-driven payment plans and public service loan forgiveness, you know that there are people out there who either owe so much or make so little that they are not as concerned with paying their loans off in full. They're concerned with paying a percentage of their discretionary income and eventually having those loans forgiven. So, for example, if you owe $300,000, and for those of you out there who don't think that's possible, it's possible, and it's possible to owe more. But if you owe that amount and you don't make enough to pay those loans off in full, the income-driven plans can be appealing to you because they say that as long as you pay a percentage of your discretionary income for 20 or 25 years, those loans will be forgiven. Or if you make so little that you're on that same track where it's unlikely that you can pay your loans off in full in any reasonable period of time, then of course you want to stick with a federal student loan because it offers loan forgiveness, it offers public service plans, and a number of different features that might be attractive to you. But what if circumstances line up that you actually do owe an amount that is manageable and possible for you to pay off in a reasonable period of time? You might find that by doing a plan like the income-driven plan, where you spread out those payments over a course of time, that you are actually costing yourself money because the interest rate on those loans might not be amenable to you. And what I mean by that is, if you're doing an income-based plan and you're on track to pay those loans off in full, the loan forgiveness isn't important to you. How fast you can pay off your loans is important to you. And while federal student loans do offer a number of advantages, they don't necessarily offer the lowest interest rate. So if you're in the situation where you see that by paying off these loans in a certain period of time, you are actually costing yourself money because of the higher interest rate offered by a federal student loan, then it might be worth your time to either A, not do an income-driven plan and do a standard loan payment where you're projected to pay off those loans and your payment is based off of the amount actually needed to pay off those loans, or B, refinancing to a private lender. So what is a private lender and how do their student loans work? Well, first of all, you don't have to feel any loyalty to a federal student loan. If you refinance to a private lender, be it a bank or simply a lending institution, essentially they will cut a check to the federal government or your loan servicer for however much you owe, and then they will take on that debt from them, and you now have a new loan with a private lender. When you get to that private lender, there are typically two different ways that you can apply for that loan. First, when they determine your interest rate, they're going to use a formula that is not just based on your credit score, but it's also based on the security of your job and the income that you are earning, as well as the amount that you owe. So all of those factors mix into what they use to consider the interest rate that they're going to offer you. And there are typically two different ways that they will offer you interest rates on these loans. The first is a fixed interest rate. And that's pretty simple. Your rate is fixed. It doesn't change. It doesn't go up. It doesn't go down. And whatever they're offering you will stay the same throughout the course of your loan payment. So for example, if you are on a 15-year payment plan with the federal government at 6%, and you find a 15-year payment plan with a private lender at 5%, that could potentially lower your payment. Or you may see a 10-year payment plan at 4%, and when you run the math, you figure out that it's exactly or similar to what you would pay for the longer repayment period. That would be an example of why it might be worth considering taking those federal loans and going to a private lender on the fixed side. Private lenders also offer something called a variable interest rate. So instead of giving you one rate, 5%, they may say you could pay anywhere from 3% to 6%. And the reason that they do that and how they do that is based off of something called the LIBOR, LIBOR. And I'm not going to bore you with what that is, but all you need to know is that is an index that can change as frequently as daily. And that means that your rate could change as frequently as daily. So something that you're paying at 3% today might be 3.25% tomorrow. You just don't know. So why would somebody choose a variable rate over a fixed rate? Well, the lower rung of a variable rate is typically going to be a little lower than what they're going to offer on a current fixed rate. So in this example, 3% is lower than the 5% fixed rate that they offer you. And if you are, I won't say a gambling person, but if you are somebody who thinks that interest rates might stay low for a while, you might think it would benefit you to pay that rate, even though you know it could change, because over the course of time, you are hoping that it shakes out in your favor when you look at the interest rate you're being offered for the variable as opposed to the fixed. Now, this last part, I will say proceed with caution. Similar to how I felt about credit cards in the credit series, where I said I was concerned about bringing it up because I don't want to put you in a situation where I've told you a strategy you're not in a position to use effectively. That is definitely how I feel about this strategy. But I do recognize there are some people who it could help, so I want to share. Essentially, people oftentimes, they look at their debts in a vacuum. They look at this one debt and they don't associate it with the other payments that they're making, and they don't consider how working together could put them in a better situation in terms of how much they're paying overall each month and the interest rate that they're paying. By you taking your student loan and analyzing its effect on your other debts, you might find that by utilizing your home loan, you can put yourself in a situation where that interest rate can be lowered, or you could at the very least have more favorable terms. Let's look at how. Let's say we have a couple who live in a house that is worth $200,000, and they have a mortgage on that house that is $100,000. This means that they have $100,000 worth of equity being the difference between what they owe on the home and what the value of that home is on the open market. Many banks will say that you can refinance a home up to a certain percentage of that home's loan to value. And that means they look at your equity and they say, we'll let you refinance this home, and we will let you either take equity out of the house, which increases your mortgage, or we will let you consolidate some of your other debts as long as it doesn't exceed a certain percentage of your loan to value. So for example, if we had a $200,000 house and we refinanced and added $60,000 worth of debt to that house, we would now be at 80% of that house's loan to value, $160,000. So let's assume that that same couple, $200,000 value of a house, $100,000 mortgage, has a mortgage that's at 4% interest. And they also have student loans of $50,000. And that $50,000 student loan is at an interest rate of 6%. So if you don't think 2% makes a difference, I can tell you over the course of 20, 30 years, it absolutely does. If that couple looked and they said, we can refinance our property and lump in our student loans of $50,000. If they find a bank that says we will give you 80% loan to value, for example, that means that they can do this with as much as $60,000 of not just student loan debt, but other high interest debt, credit cards, personal loans. All of those can be refinanced into a mortgage, and now there is a new loan, a new mortgage. Your student loans have gone away, but you have a lower interest rate on your debt, potentially a lower payment, or a more favorable term in terms of the number of years that you have to pay on that debt. This is something you really only want to do under the advisement of a banker or an advisor that you trust, but it is something that couples have used in the past, or single people have used in the past, to put themselves in the best situation with their debt in totality, not just their student loans. A ton of information that we've covered in all of these videos. We've talked about so many things, and I hope that it wasn't information overload to you, because I didn't want to leave anything out, and we still did leave a lot of stuff out. But I thank you guys for joining me. I really appreciate the love and support you've shown since we started this, and hopefully we keep providing things that are of value to you. As always, if you like what you heard, please go to my website, share this with as many people as you can, and on my website, www.brentonharrison.com, there is a questionnaire where you can fill out things that you want covered in future videos. We're going to try to keep these coming as frequently as we possibly can. In our next series, I'm not going to tell you what the next series is, but we really think it'll be something that's valuable to you, and I hope you will tune in when the time comes. See you guys soon.